Thank you.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामंशो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्लं तदेव शुक्लब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् दोषतः सर्वे तदुन्नाद्यभिकश्चन एतद्वैता 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 एतद्वैता.
Good evening, friends, and welcome to this 8th lecture on GST sectoral specific talks. As our Honorable Prime Minister has announced on this Independence Day that GST is going to be a big gift, a Diwali bonanza for all the citizens, and we all are discussing under the true and visionary leadership of our chairman of WIRC, CA Ketan Sayyaji. Sir, we are so much thankful to you that you have given us a liberty to organize such a sectoral specific series, and with this we will be able to discuss what are the ways where taxpayers are facing issues, and maybe we can highlight those things amongst our members, and our members can then highlight the same through various chapters, or I can say with the Chamber of Commerce to the government also, where we can make this law a good and simple tax as what we envisage on 1st July 2017. We are with us our chairman of WRC, CA Ketan Sayyaji, vice chairman of the committee, CA Rajesh Agrawalji, learned faculty and friend, CA Mandar Telang, and Vratika, a coordinator for the today, and all the participants. Now I request our chairman of the WRC to have his words of wisdom to all of us.
Thank you, Bishan Bhai, the Indirect Tax Committee Chairman, Rajesh Bhai, Vice Chairman of Indirect Tax Committee, both the stalwarts having huge experience on indirect tax and equally experience and having, a lot of knowledge and been, knowing Mandar for years. So Mandar, sincere thanks to you for, coming on this session and sharing your knowledge on the healthcare industry. I think this is one such industry where, again, there are interesting facts that in some of the cases, the treatments are not taxable. In some of the cases, they are taxable. Also, there are some industries like naturotherapy where people keep discussing whether it is taxable, not taxable, Ayurvedic, the homeopathic, the product which are there are sometimes used for the as a medicine, sometimes they are used for beautification or any other purpose. I think this industry is again very, very interesting industry to learn uh, about GST, and Mandar carries huge experience, and none other than him can do justice to this topic. So sincere thanks to him and Indirect Tax Committee, which is buzzing. I think all last 6 months we've completed almost half year, and I see every week we have some or other event of Indirect Tax Committee. Thanks to Bishan Bhai, thanks to Rajesh Bhai. We had, RRC, we had full day programs, we had help desk every month. We are having 2 help desks thanks to both these gentlemen. So sincere thanks on record to both of you. At WRC level, we are announcing AI conference. The AIS 2025 at Mumbai on 3rd and 4th of October. So requesting all of you to take advantage of that. It will be happening at Yogi Sabhagrah Dadar. And I think all faculties across India, the best faculties are being called. And tomorrow or day after tomorrow, you will see the same into the mass mail of WIRC. WIRC has published one book on AI, again, very, very useful for the practitioners. So requesting all of you to take advantage of, go through that and take advantage of that. With that, thanks to all of you for having a patient hearing. Thank you so much. Over to you, Bishan Bhai again.
Thank you very much, sir, for so many great initiatives. And we had last couple of week ago our technology in GST. So what we used to say GST with GPT, and again that was a really wonderful initiative under your leadership. And we try to being purposeful, impactful, and helpful to the members. Those lectures are also online available on WRC website. So if members wants to take the benefit of those lectures, then please do visit WRC website.
No, on
And you
YouTube.
can
Bishan
on
Bhai,
YouTube.
on YouTube.
On YouTube.
WRC YouTube page channel.
Yes. So members can be benefited from that as well, because I also try to see to it, because when we are engaged at that time, it might possible that some of things we haven't grasped. So I am also trying to revise it through these links only. Again, today's topic, as sir has said, health, and there is a distinction between health and wellness, what we can say, and naturopathy. Currently, Gujarat GST has given a verdict also in AAR, AAAR, that naturopathy center, if it is in the wellness, then not liable for exemption. They are saying that its tax has to be levied, but let us see, because our central law has recognized this system of naturopathy and yoga as a valid system of medicine, recognized system of medicine. And yes, let us see how the things are moving so far as this Diwali bonanza is concerned, and what announcements are being done from the GST Council and the ministry. Yes, there are a couple of judgments also, that what we should do for expiry goods or drugs, or when there is a scheme so far as the pharma is concerned, where they are giving trade discount, bulk discounts, and all those things. We will see to it, Mandar Bhai, from your lecture today. Now I request our today's coordinator. Yes, Rajesh Bhai, do you want to add anything, please?
No, please continue.
So we request CA Vritika to give formal introduction of CA Mandar Telang.
Hello, good evening, everyone.
Yes, good evening.
CA Mandar Telang is a distinguished chartered accountant with expertise in indirect taxation, including service tax, VAT, and GST. As a seasonal practitioner, he has extensive experience in appellate and chamber practice. He is actively involved with various professional bodies, serving as a convener of Indirect Tax Committee and Study Circle of BCAAC, and member of the Indirect Tax Committee of the Chamber of Tax Consultants. Mandar also been a co-op member of the Indirect Tax Committee of ACAI, and a faculty as a seminar and workshops on service tax. He is a prolific contributor to professional journals and author of the book Service Tax Basic Concept and Procedure. As an NSCIN accredited GST trainer, he continues to share his knowledge with the industry.
So thank you, Ritika. And now I request CA Mandar Bhai to take it forward. Thank you very much, Mandar Bhai, for your acceptance. And
Thank you, Bishan. Thank you,
Yes.
Ketan ji. Thank you, Rajesh ji, for this wonderful series that you have started. I must compliment the efforts and the initiative in coming out with such a wonderful, extensive, sector-specific series. I'm glad that you offered me this topic because this is one of the, I would say, favorite topic for me. I have been handling in some of the cases and very much interested in the way the litigation is getting, happening, especially in the pharma sector, or I would say the healthcare sector, if I have to use it in a broad manner. uh, Both the pharmaceutical companies where there is a issue, the other side is hospitals where some treatment, some amendments we have seen. What is clinical establishment? What could be regarded as a healthcare service which is exempted? So that is the second line of the argument. But for this session, I would be more focusing on the pharma sector as a manufacturer. We may at the end may touch upon some of the other healthcare hospitals related aspects if time permits. Um, I, before I begin, I must endorse the view which was expressed here by Ketanji regarding AI. Both Bishan and Ketanji spoke about it. I'm a huge fan of AI thanks to the various initiatives that the ICI is taking up for that. I think they are at the forefront. No other organization is doing the activities as the ICI is doing on the AI front. I have been, I've seen the hackathon final series which was available, superb, and some of the finalists are in touch with me. I am learning from them various things. So thanks a lot for these sessions, and I also appeal that whatever conferences etc. are coming up on AI, I would be the participant. You would also become the participant. That would benefit the profession as a whole. With this, let me start with the topic that has been allotted to me today. I am just sharing my screen. Just confirm if it is visible or not.
Yeah, visible.
Yes.
Yes,
Visible.
visible.
Yes. So the broad topics that we are going to cover in this case are, one sec, let me do some screen adjustments. One second. Yeah. So the broad topics that we are going to look today are the stock transfers of the promotional items and the physician sample. There are varied practices that are currently happening in the pharma sector as far as these two items are concerned. Different views are taken. Some people are taking a view that ITC is required to be reversed. Some people are saying that it is not required to be reversed if you strictly read. So we will spend some time on the taxability, the issues revolving around the stock transfer and the physician samples. The other is the reversal of the ITC of the expired goods or the near expired goods. I believe Beshan shared with me yesterday one of the decision of the Gujarat High Court where the notice has been issued to the state. So this aspect, this issue has now come up before the High Court. Soon we are going to see some jurisprudence on this particular area. I believe that besides the logic, the circular, certain paras are also challenged in that particular petition. Promotional schemes, incentives, and discount models, something where we can draw some support from the pre-GST regime. I believe when it comes to these sort of things, there are also things where we have to be a little bit cautious, especially where it involves issuance of the credit notes. So that is one aspect that we have to see. Research and development activity, the place of supply issue, that is something which one needs to, be very careful about. This is the thing which is bothering the industry much. The exact view that is to be taken depends upon certain factors, and therefore some discussion on this aspect I felt that would be necessary in this session. Transfer pricing, debit notes and credit notes. Most of the pharma companies have got the establishments outside. And then, as far as their foreign markets are concerned, obviously, the export as well as the expenditure, there are certain tax regulators and requiring tax treatments, which has some implication on the in the India as far as the GST is concerned. And therefore, I think I thought that I should also touch upon these aspects. Export of goods and refund, I think we are all aware, not much. I have just considered it as a point for the purpose of completeness, especially in view of the fact that now recently the amendments have been carried out for the purpose of also uh, payment of the erroneous tax refund if in case the credit notes are issued, or the debit notes where the tax has not been paid, you have to pay and apply for a refund. So that window has opened, circular has been there. So a little bit of that particular aspect might be discussed over here. And the last one, the regulatory payments and the suits abroad in India, the taxability of that. That is one aspect that we will cover. As already mentioned, if after discussing this, if any time permits, then probably a small portion of what I would consider as a healthcare service when it comes to the exemption attributable to the clinical establishment, that's something I would like to cover. And with this, let me take you to the first issue of the stock transfer of the promotional material, etc. So we all know that when it comes to the promotional material, like brand reminders, where the generally the pharma is allowed to give the send the small brand reminders to the distributors, to the end customer or the doctors, etc., medical practitioners, where generally the value is less than 1,000 rupees, a calendar or a pen stand or some other item where generally the branding of the and branding of that particular entity comes. Now, the question is, there are twofold questions. One, whether you can treat it as a gift, whether it is something which would result into a inability or the disability in terms of availability of the credit under section 17(5)(h). If yes, then where the credit is required to be reversed, whether it is required to be reversed in the state of origin or in the state of consumption. So these are the 2 points where, again, different practices are being followed in the pharma sector. As regards to the eligibility of the credit, section 17(5)(h) uses the word goods lost, stolen, destroyed, written off, or disposed of by way of a gift or a free sample. Now, when you are talking about a gift, it's basically, something that is given out of a gratitude to a particular person. And it's basically to make feel good to that particular person that you give the gift. The argument on behalf of the people who believe that there should not be any this should not be considered as a gift is that they are saying that when you are giving the brand reminder, nothing in those brand reminders are making the distributor or your doctors very happy. It's not something that they are looking forward to get. A gift is something. So on a Diwali, if a particular company is sending you a tablet or a particular company is sending you something, then you are obviously looking forward कि last year दिया था ये साल भी कुछ देंगे. See, that is gift. But if those people are sending you the reminders, brand reminders, such small gift articles throughout the years, then can you really call it as a gift? And it is at that particular stage where the disputes arise. Some people are taking a view that the brand reminders where my brand name is printed cannot partake the character of the gift, because that is something that we are giving. It is our own expenditure, that is our advertisement expenditure, and therefore when we are giving it to other people, it is not something which would result into a sort of a supply. It is not something which we are talking about that it would result into a giving away of a gift. It is an expenditure that we have incurred for the purpose of promoting our business, our brand, and therefore it should be allowed. There are twofold arguments. Number one is that there is no doubt that it is for the purpose of promotion of my brand or my business. And secondly, it would not partake the character of the gift due to its very nature, namely that it carries my brand. It is not something which I am giving away as it is by buying it from the market and giving it to the other party. It carries my brand. The purpose of that is basically that that particular person should keep it somewhere in his office or in his store, so that when people come they would see, this is the company. So it would automatically result into my brand advertisement, and therefore brand reminders would not, by their very nature, would fall within the parameters of the gift. And that is an argument that the people are making in taking a view that in this case, the ITC is not required to be reversed. Because see, sometimes what happens, what would be considered as a gift? That is also one aspect that needs to be remembered. If you take an article, if you buy an article from the outside, if you take that article and if you give away that article, there must be some branding, etc., for which some job worker or something might have done. But in that particular case, you can still call it as a gift. But there may be sometimes calendars, etc., which are not really speaking, bought. That item comes to you by way of pure job work, printing, service. So when the item that you are buying is a service, the person is giving you a service invoice, then can you say that that service that you are buying is given away by you as a gift? So that is also one aspect that one needs to be seen, is that gift is something when I'm trading, when I'm buying something and giving away as it is. When I am taking a service and the end product of that service, which is a calendar, which becomes a tangible product, when I am forwarding it further, not as a printing service, but as a calendar, can you treat it as a gift? That is also one more aspect that people are required to see. And therefore, there is one argument to say that this would not partake the character of a gift. It would not form in any of the classifications which are mentioned over here, like lost, stolen, destroyed, written off, or disposed of by way of a gift or a free sample. In none of these parameters it will fall, and therefore it is possible to take a view that I do not have to reverse the credit in respect of the brand reminders. Having said this, I would say that most of the pharma companies, to my knowledge, are reversing the credit to avoid the dispute. They are rather comfortable in reversing this particular credit and taking a hit to a P&L account, taking probably some tax benefits that they may get by virtue of this expenditure. But uh, uh, those who are, reversing the credit, the next question comes where they have to reverse the credit. Now, here also there are two schools of thought. The one school of thought is that it needs to be reversed at the place of origination, because when you are buying any gift item, it is the company which is the end consumer. And therefore, when company gives it further, it is not really speaking entering into a chain of distribution. It is entering into a chain of consumption, but not into the chain of distribution. And that consumption is not something which would result into any value addition to anybody. And that's the reason I'm reversing the ITC. And therefore, when it is not resulting into any value addition, if it is my own expenditure and if the entire credit is something that is coming to me in a state A, then I need to reverse that credit in state A only. All the onward movement of that particular item would be through delivery challan only. If anybody tells me that you have not paid tax on this, the delivery challan is incorrect, the tax invoice you should have prepared, if there is an e-way bill issue, something, then I would defend that particular aspect by saying that in my delivery challan, I have specifically stated that this is not meant for distribution. I have also stated that I have reversed the credit, and therefore the e-way bill issue or something would not arise, because what I do not consider as a supply cannot be considered as a supply, and therefore the entire credit needs to be reversed at one place. So this is one line of argument where the people are taking a view that the supply ends at the place where the gifts are procured, and therefore the entire reversal needs to take place in the state where the goods are bought. Let's look at the other side of the argument, where the people are taking the view that it should be reversed, not in the state where the consumption is happening, but, or rather the company is buying it, but it should be reversed at a place where the actual consumption is happening. That is actually where those goods are, transferred or given or distributed to either end customer or to the storer or to the medical practitioner, whatever you call it as. So at that point of time, you need to reverse the credit. And generally in the pharma, the chain of distribution is such that it reaches to that particular C&F agent, which is basically located in that particular state. And from there, it gets distributed to the same state or in the nearby states, whatever it is. So therefore, it is that point or in that state that the ITC is required to be reversed. If you take this particular view, then in that particular case, the argument is that I will have to transfer it by way of a stock transfer invoice. Wherever I am purchasing, suppose I am purchasing in Maharashtra, then from Maharashtra to Goa, I will have to issue a stock transfer invoice. I will have to transfer the credit. And from there, I will have to reverse as and when those particular goods are sent for the forward distribution through MR or my employees or whatever agencies, distribution agencies. So this is the argument. Another argument where the view is very strongly coming up is that you don't have an option to reverse this at the credit, because whenever any movement of goods is happening between your own distinct persons which are located in different state, that is my own registration in the state of Maharashtra and my own registration in the state of Goa, then in that particular case I have no option, because the deeming fiction which is given in schedule 1 serial number 2 will come into play, and therefore I will have to issue the invoice in, even if it is not a supply of goods, and therefore I would be required to charge the GST on it, take a credit of that particular to the recipient state and reverse the credit over there. Now here again, the point one needs to really debate about is whether schedule serial number 2 schedule 1 has got a power or the mandate to convert something which is not a supply to a supply, or whether it has got a mandate to convert something which is a supply but not a supply merely because of absence of consideration into the deemed definition of a supply. If we treat a view that there is a blanket permission given in the schedule 1 to treat any supply, any non-supply as a supply, then I think the view would be erroneous. The limited purpose of schedule 1 is to treat a particular transaction which is otherwise a supply but fails to become a supply for absence of consideration. So therefore, whether a particular transaction is otherwise a supply or not, that needs to be examined. Without examining that, if we look at schedule 1 only to look at the the consideration part, then in my view it would be difficult, and therefore one needs to examine when there is a transfer or the movement of free supply or these gift articles or these brand reminders happening from one state to another state. Are there, really speaking, supply as contemplated commercially happening or not? If there is no supply happening in such case, commercially there is no intent to make our supply as such between the different branches. It is only the movement of goods for the better distribution. Then I would be inclined to take a view that the better view or the legal logical view would be to reverse the credit at the first stage. But if the company itself is taking a view that no, for us it is, we are treating it as a supply only, ultimately it's a, for the company as a whole it is a revenue neutral, so we will be taking it as a supply. We will consume, we will be more practically, we will take a view that let us take it in the state where it is ultimately living, because otherwise those states will give a problem to us. Then that's a different matter altogether. Therefore, when it comes to these brand reminders, etc., as I've told you, two aspects. One, whether a ITC reversal is required. There again, the two views are there. My view, safer view, if those who do not want to take an aggressive view, better to reverse the credit. Second, as far as where to reverse the credit, my personal view, my favorite view, which I have been advocating, reverse it in the state where you have bought it, because it is not supposed to enter into the chain of distribution, or you are not in the business of selling or supplying that particular aspect. But both the practices are being followed. This aspect of the reversal as of now have not been taken up. I have not heard by any objection has been taken in this regard. But nonetheless, this is an issue that one needs to see, especially because when you are reversing it in the originating state, the ultimate state where the goods are going to go is going to lose some revenue on account of the reversal of the ITC that would have otherwise happened in that particular state. So therefore, it's open for both the state to debate on this particular aspect. So this is the first issue that I wanted to discuss. I'll now move to the second issue, reversal of an ITC in respect of expired goods or near expired goods. Now we all know what is the background or what is the scheme of the law when we are talking about these sort of goods or expired goods. So typically, so before coming to this, let me also deal with the physician samples. So yes, physician samples, in my view, as regards the disallowability or the ineligibility in terms of section 17(5)(h), I believe is a little weaker case as compared to the brand reminders. There, in my personal view, it is advisable to have the ITC reverse, because those physician samples, although they may be considered as a part of, um, reversing the part of the advertisement only, you want to just show. Still, fundamentally, if you really ask me, fundamentally that particular aspect, those particular goods are going to the customers for the purpose of consumption. It is basically going not for the purpose of display or anything. Those goods are ultimately going to be utilized. So therefore, somewhere I would like to make a distinction between the samples and the brand reminders, because samples are meant for consumption so that the sale of the same type of good increases. So it is like something I am giving you free, something I am supposed to give you free. I am producing, it is a part of my money. There is no difference between the commodity that I am selling and the commodity as I am giving away for free sample. Both are my products. Only here I have marked it as a physician sample because I have not yet, made in that commercial. I want to tomorrow do the volume. Once I get that particular market share, once the people start consuming and appreciating it. So therefore, physician sample I would not put on the same footing as that of the brand reminders. There I believe that the reversal of an ITC is something which which would be the smart move. And yes, again there the question of where it will be reversed, etc., would still come. I believe there the logic remains the same, because once you are saying that those particular items are not eligible for credit at the first instance, then against the treating it as a supply and all those things in between, distinct person would not come. So as regards the reversal, place of reversal, I would not make a distinction between the two. But as regards the eligibility, whether it is considered as a items eligible, probably both can be looked at a different footing. In the first case, if you have already taken a view that the reversal is not required, it is still possible to defend. But the smarter move would be not to take a chance, not to litigate, reverse, and go ahead. That would be my view as far as this particular aspect. Coming back to the expired goods, I believe that we all are familiar with the way this model comes. I have just tried to give the pictorial representation. So the manufactures the item, send it to the distributor send it to the retailer. Now, retailer, if he is not able to sell, then there is a tacit custom understanding between the manufacturer that you will call for those goods, you will take back those goods, and not only that you will take back those goods, you will destroy those goods, because there is a obligation on you in terms of the biodegradable waste management, or the what we call it as a pharmacy act, that we need to, all these goods which are not fit for human consumption, there is an obligation on the manufacturer to make sure that it does not remain in the distribution, take it and incinerate that particular item. And therefore, when we are talking about the reversal of an ITC, again in the context of 17.5H, destroyed goods, are we really talking about the goods which are already sold and which are taken back by me, or we are talking about the goods which are not sold, which have not entered the distribution network, which are lying at my premises? That I believe is a very valid distinction that we need to make before coming at the conclusion. And therefore, let's take the case of the expired goods first and then the near expired goods. So when we are talking about the expired goods, at that point of time when manufacturer is selling to the distributor and distributor is supplying to the retailer, at every stage the tax is paid. And therefore, once the full tax is paid on the entire price that ultimately the retailer is supposed to pay, who becomes the final customer in respect of the expired goods. And tomorrow, when he gives that particular goods back after the expiry, at that point of time, strictly speaking, there is no supply from the retailer to distributor or to manufacturer, whoever that particular person is returning those goods. Those goods no longer retain the character of the goods after the expiry. There is a decision of the US Foods Delhi Tribunal, old judgment, very categorically stating that the goods food once expired does not become fit for human consumption, and therefore you cannot circulate it, and therefore to that extent it ceased to become a marketable commodity to call it as a goods. And therefore I would take a view that when the retailer who becomes the end consumer, who has paid the entire amount of that particular goods, when he is returning those goods back to the supplier or the manufacturer for the purpose of destruction, etc., then the manufacturer or the destroyer or the distributor who has paid the entire tax on the price that he has charged to the retailer is not required to reverse any credit as far as that particular expired goods are concerned. Now the question comes that when the retailer who has taken the credit fails to further supply it in the market, then what would be the treatment? Whether he can still continue to retain that goods credit with him, or does he require to reverse that particular credit? There, I believe that when that particular retailer is returning the goods because he is unable to supply those goods in the market because they are expired, at that point of time, the equivalent amount of the ITC in respect of those goods is required to be reversed in the hands of the retailer. The general understanding between the pharma company and the retailer is that in such cases, whatever is the credit that he is supposed to reverse, that burden will be either shared fully or partially by the manufacturer in the form of passing off a credit note. So therefore, when that particular goods are returned back, suppose 100 rupees is the price of the goods, 6 rupees is the tax, 106 is the total value, 6 rupees credit is taken by the retailer, and when he is giving the entire goods back, at that point of time, either the company will give him the credit note for entire 106. When the company gives the entire 106, it is extremely wrong on part of the retailer to take that 6 rupees credit in any way, because then it would become a double benefit, which no, he won't be able to even justify in any court. So therefore, that is a very difficult aspect. Even otherwise, suppose the manufacturer says that not 106, I will give you only 103 or whatever number. In that case also, I believe the law will prevail as far as the reversal of an ITC in the hands of the retailer. And therefore, retailers in this entire pharma industry, I would want them to become a very cautious in this particular aspect. There is a circular which says that here they have got two options. Either the supplier can issue the credit note on the stock return, or the invoice can be issued by the retailer. In my view, as far as the expired goods are concerned, it is not correct to issue the invoice, because that is not a supply of goods. The goods no longer remain the goods, and therefore issuing the invoice in my view would be incorrect. Although the circular very categorically in an unambiguous matter clearly says that this option is allowed, you can take it. But in my view, that is not a correct practice, that is not a hygienic practice, and therefore I would refrain from advising to you that in cases of the expired goods, let retailer issue the credit note. The idea in that particular case is that if the credit note is issued, if the invoice is issued, then there is no need for a reversal of the credit in the hands of the retailer, and whatever the credit, whatever the amount is mentioned in the invoice, to that extent anyway, no amount will be paid by the manufacturer to the distributor to the retailer, and by the manufacturer to distributor. So all people will nullify the transactions which have happened by way of a supply as a transaction which are happening by way of a return supply from retailer to distributor and distributor to manufacturer, and ultimately the manufacturer will reverse the credit which he has billed to the distributor. To that extent he will reverse the credit, and therefore when he is reversing that particular credit, yes, the actual loss which is happening is not the uh, output tax that you are paying, but the actual loss that you are happening is the price at which the manufacturer has sold. Only to that extent, or maybe even less than that, the cost of the goods involved in that is something that you have to reverse. So therefore, those people who are trying to minimize those losses by treating it as a reverse supply, in my view, in respect of expired good, that would be a very tricky situation. I would not venture in that area. But yes, if it is a near expiry goods, then there are possibilities where the company, subject to the regulations, if the regulations permit, can buy the whole lot of the medicines at a very cheap price. So let us assume that there are retailers who have the near expired goods. Now, if those retailers having the near expired goods give invoice those goods back to the distributor. That is a perfectly valid thing. Nobody can say that you can't do it because that is not an expired good, that is still a goods. I am giving it back. Now, when they are giving it back, the question might come that at what price they are giving it back. Obviously, the retailer does not want to lose anything, any margin, etc. So the understanding with the company would be that whatever price you have paid, on that same price you reverse it or you invoice us back so that you will be nullified. Your score will be tallied. Once that amount comes, then the company might sell it to third entity, which would be the people who would be buying such kind of goods and trying to sell it at an extremely cheap price because they are nearing expiry. And in that particular case, when they are nearing expiry, they are selling it at a very cheap price, maybe 50%, 60% discount. It may be possible that in the hands of the company selling, there is no danger to the credit because they have already sold the goods at a lower price. There is nothing in the law, fortunately, today saying that the price at which you are supplying the goods to an independent buyer has to be equal to or more than the price at which you have bought it. That is not the law today. If it is the case of the transaction between the related party, then yes, the question might come as to the supply because the goods once expired, the related party may not be able to use the full credit and there the question of valuation would come into play. But in case where there is an independent entity not related buying this particular item at say very cheap price, then the credit loss of that particular item is not as it was if you are talking about in expired goods. And therefore, this is one aspect subject to regulatory requirements. Obviously, the companies are exploring today of buying the goods at a very near expiry items, saving a lot of input tax on that, selling it at a very low price, and then whatever the other party, independent party can sell, that they will sell, they will record it as a supply, they will pay the tax. Whatever they cannot sell, whatever are expired at their hands, they are basically reversing the credit at their end. The credit that they are reversing is far lesser than the credit they are originally reversing. So that is as far as this particular aspect is concerned. Those who are taking the benefit of tax credits, what I have explained you just now are only in respect of the financial credit notes, because the financial credit notes, it is absolutely safer side, safer bet, not involving much of a litigation. The only issue there which comes probably prone to the litigation is whether the retailer has reversed the credit or not when he is returning the expired goods. Otherwise, there is no, because the government has not lost anything. They have got what the price they were supposed to get. Therefore, to that extent, financial credit notes are a safer bet. When you are talking about the tax credit notes, there are two things one needs to be very careful about, or rather, three things now. The first thing is that whether the um, whether the um, uh, other party has reversed the credit on the tax credit note that you are giving. So that is the first part. And especially with the today's LMS, IMS, where they are asking you to, approve the invoice, approve the credit notes. Approval of these credit notes are becoming a lot of problems. I have heard that this aspect is not happening very smoothly, even at least today. Maybe in future it may happen, but that is one challenge that comes. Secondly, you will have to prove that the incidence of tax has not been passed on to the customer when you are issuing the credit note. That is also one thing. And when we are talking about the incidence of the credit note, one needs to say at what level you have to stop. So suppose A supplies goods to B and B supplies goods to C, and C gives goods back to B and B gives goods back to A. Can A say that when the B has given goods back to me, that means incidence of tax has not been passed on by me because to that extent I have given the credit note? Or whether he has to also see whether the B has given the similar treatment to C. That is the question. Unfortunately, there is one Supreme Court ruling in the pre-GST regime which takes a view that it is not just your customers, but the burden that your customer has passed on to the customer's customer should also be viewed while referring to this particular condition of passing of the incidence of tax. And therefore, this becomes a very tricky situation in that particular case. And therefore, issuing the tax credit notes, in my view, is a little bit risky proposition. one needs to be extremely careful. The third aspect that you have to also look at is the declaration of those credit notes in your return and the period within which you are declaring that particular credit note. That is also the third aspect that may come as an embargo, especially when the expiry limit is not spread over the 1 year. If it is more than 1 year, 2 years, 3 years, that could be an issue. So these are some of the points I wanted to highlight when it comes to the reversal of an ITC in respect of expired goods, near expiry goods, etc. I'll now take you to the next level: promotional schemes, incentives, discount models. Now, when we are talking about the promotional scheme, so first and foremost, the quantity discounts. So when I am giving a scheme that with 10 strips, 1 strip free, or with 20 packets, 2 packets free, am I actually giving a free supply or not? That is the question one needs to see. Now, there are judgments. If you look at the judgment of the Indica Laboratory or the Queen's Chemist, Bombay High Court, the view is very clear that there is nothing like a free discount. And when you are giving a quantity free for a price of lesser quantity, then actually what you are giving is a price discount only. It is only that instead of reducing the price, you are increasing the quantity and the discount is passed on by way of a hidden discount. So instead of taking a higher price, you take a lower price for the same commodity, and therefore a quantity discount or a discount given in terms of offering more quantity is nothing but a discount, and therefore in such cases the deduction of the discount should be allowed. That is the decisions which are coming from the previous regime. I think the decision is fairly settled. There are no two disputes about it, and therefore merely saying that I am giving you 1+1 free, I believe would not have any problem. The care that one needs to take extra, apart from the legality of this particular aspect, is while giving such discounts, please mention that free quantity in the discount column, because if you in your invoice show it as a free, then it would unnecessarily give rise to trouble of you explaining to the department all these case laws which are unlikely to be accepted at a very lower level. You may have to probably get the relief either from the commissioner appeal or from the tribunal, and therefore as a matter of caution I would recommend in such cases, although your promotional material etc are all telling it 1+1 free, at least in the invoice that you are issuing, show that particular amount as a quantity discount. I have asked some of my clients as to why, what is wrong if you don't show it as a quantity discount but if you show it as a price discount. They say if we do it, that our marketing teams may have a problem, and therefore it becomes difficult for them to justify, and therefore we don't want to change the entire model. Just tell us legally whether it is right or wrong. And there my response to them is that legally you don't need to worry. Just instead of showing it free in the invoice, show it as a discount. I think that should serve the purpose. If tomorrow something happens, I think you have got a good ground and good documentation to suggest your case. That is the first aspect. The second aspect, suppose, how do I know? What is the other part? How do I know that this would be treated as a discount for my distributor or the second chain? One more factor that the courts have held in the past as would be indicator to the fact that it is a discount is that whatever you are passing on to your distributor extra, whether it constitutes his margin or not. So if you give him extra quantity and he can sell it and keep and retain the price of that extra quantity for himself, then that would be treated as a discount. So when we are talking about, say, same product to additional quantity, let us take a case where you are not giving the same product. You are saying instead of product X, I will give product Y as a free product. Whether that would become a free product merely because it is not the same product, or whether it would still constitute the character of a discount, that is something one needs to understand. So there, one of the indicators is that whatever I am giving free, if that constitutes the margin of the dealer or the retailer, that means he is free to sell that particular commodity and earn money out of it, then one can say that in the hands of that particular promoter, the free quantity offered is nothing but a discount which is given by, so it is a discount in kind which is given by the manufacturer to that particular dealer. So that is the other aspect that one needs to see whether it constitutes the margin in the hands of the dealer or not. So let us take a case where I am giving two items to the distributor and I am telling him, I am binding him that ki, as far as the free item is concerned, you can't keep it for yourself, you can't sell it, you have to give it, pass it on further at the same price that I have printed on the paper on that particular label. Then in that particular case, one may take a view that that item does not constitute a discount. Then in that particular case, one needs to see if it does not constitute a quantitative discount because it does not add to the margin of the retailer. Can it be considered as a free supply or can it be considered as a combined pack? If you take a view that it is a combined pack, that means you have to supply both together because there is one price declared for both. Then in that case, the question of mixed supply or the composite supply would come into play. There again, the reversal of the credit would not be applied because it would not be free. But the question of the rate that you are going to apply, depending upon whether it's a composite supply or a mixed supply, whether you are in a position to identify the principal supply or not, that would determine what would be the rate. If both are falling within the same parameters, then I don't think there would be a problem. But if the rates are different, then one needs to really see if one is categorized as a medicine, other is categorized as some equipment or something like that, the rate may differ. So in that case, one needs to see. But if otherwise it is considered as a common or a combined supply or a packaged supply and a principal supply, then again the reversal of an ITC would not come. It would not be considered as a discount, but at the same time, it would not be considered as a free gift. It would be considered as a combined pack, multi-pack, and therefore in that case also the reversal of ITC would not arise. Obviously, one needs to see the principles of the composite supply and principal supply. Going forward, the third limb, where it is neither a discount nor a multi-pack, and you are saying that you have to pass it on to the final customer, and everywhere in the literature to the final customer, it is promoted as a free item. In that case, yes, one may take a view that it would partake the character of a gift, it would partake the character of a free supply, and therefore, so again here, the same question of brand reminder, the same argument of the brand reminder can be made that this is really speaking is not a free supply, this is really speaking not a gift, it is nothing but a advertisement material, marketing material, and therefore I need not reverse the credit. But there again, as I've told you, one needs to really see, only the courts will tell whether this would partake the character of the gift simpliciter as is mentioned in 17.5H, or it would not contain the price simpliciter or the gift simpliciter, that one needs to see. So there again, the views are gray. One needs to really see only when the court decision comes in that particular case. But there would be an issue 17.5H reversal as far as that particular free portion, because it is neither constituting the margin of the distributor, not constituting the margin of the supplier. So that is how I would try to end up this particular aspect of the discount. Incentives, the second aspect. What do you mean by incentives? So if you make a particular sale, if you achieve a particular sale, then I will give you certain additional amount by way of a credit note. That is an incentive. Now, whether it is declared in advance, whether it is not declared in advance, to my view, it doesn't matter, because incentives are ex gratia. They are the business theatres, they are the business customs. It all depends on the person who is giving that incentive, whether he wants to give an incentive or not. And therefore, in those cases, when you are talking about an incentive, when the decision to give either incentive in the form of a gifts or an incentive in the form of a money or the credit note, when that comes, that decision lies with the supplier. In that particular case, I believe the character of that particular amount would be purely and purely as a business expenditure. It cannot partake the character of a consideration for some marketing service or some promotional or whatever business support or business auxiliary services that are being provided by the dealer to you. It can't be considered as that. I have been told in various cases in the audits, these points are coming up that people are saying that the department is taking a view that all the incentives which are shown by you as an incentive in your financial statements would partake the character of consideration for services. I believe there is enough jurisprudence available. Same issues were there in the automobile sector. There number of judgments of the tribunal are available, taking a view that in such cases it cannot be regarded as a consideration for supply of service, and therefore there would not be any invoice that the recipient of these items is supposed to issue. If you are giving the items amounts in cash, obviously there is no need. Only thing is that when you're talking about incentive, please note that they cannot partake the character of a discount. So credit note, when you are issuing for the incentive, it has to be a financial credit note. It cannot be the tax credit note. So that is one aspect that one needs to see. When we are talking about the credit notes and discounts, we all are aware, we are in the 7th, 8th, 9th year of the GST. We all are aware that for discounts, and these are the principles which were also there in the previous regime. So we are all aware that for a discount, to get the deduction from the value of the commodity so as to reduce the rate of tax, also has to reduce the amount of tax, it has to be known much more in advance. It has to be decided between the parties by virtue of the contractual terms, either express or implied. Unless the discounts are known in advance, the deduction is not available. And therefore, when you are going to give a discount, when you are actually going to pass on the discount, it is immaterial, whether it is before or after the particular event happens, particular supply happens. But the fact that the discounts are agreed upon, that must happen either before or at the time of supply. That agreement cannot happen after the supply takes place. If it takes after the supply takes place, then there are going to be disputes. In the past also there were disputes, and therefore to that extent the tax credit notes for the post supply discounts not backed by the agreement at the time of supply would be in dispute. That is as far as the discount goes. I think we have tried to cover all these judgments which were there. Hindustan Lever, Bombay Latex. I think there was one judgment. I believe that some sometimes the arrangement happens. I'm talking about the MRF decision. Sometimes the arrangement happens whereby some part of the advertisement expenditure is incurred or is borne by the manufacturer, and for that expenditure some debit notes are raised by the distributor on the manufacturer. So the question also comes whether that would constitute a consideration for supply or not, or that would constitute a discount in the hands for the purpose of giving. So there again, my view is very clear that it would not constitute a discount. It is an expenditure. When you incur that expenditure for advertisement purpose, depending upon the applicability of 17(5)(h), either you will be eligible for the credit or you will not be eligible for the credit. If that expenditure is your responsibility, if the instead of debit note, a tax invoice is issued by the dealer to you as a manufacturer, you would be able to take the credit subject to 17(5)(h) examination, because in that case, that agent who is actually paying for that expenditure and giving you a part of the expenditure as a part of the contribution is acting as your pure agent and is allowed to issue you the invoice as a pure agent and pass on a part of the credit on you. And therefore, to that extent, in my view, the credit chain is not broken to the extent you agreed to pay for that particular amount. Although if the invoice is not in your name, but in the name of the dealer, and dealers issue the invoice in your name, and therefore to that extent, the credit there, I believe the manufacturer would be able to take, provided the 17(5)(h) bar is taken care of. So that is as far as the MRF. There was MRF judgment which basically said that some compensation was paid to the customer because if the rubber quality or the tire quality, if the tire gets replaced in a very short span, then it is regarded as a manufacturing defect, and therefore some compensation is paid to the customers. Whether that can be considered as a discount, obviously not. It can't be considered as a discount. It is purely and purely a goodwill gesture of the business expenditure, not in the nature of a discount, and therefore you can't take a benefit of the discount reduction in as far as that particular aspect is concerned. I think I have tried to cover. There were some circular issues. I will not go into the nitty-gritties of the circular. some circular issues, some circular withdrawn. So anyway, circulars do not lay out the law. Whatever is the principles which I believe was necessary, I have already covered. So I'm not referring more to the circulars now. Let me go through the next aspect of the R&D, place of supply. Bishan, I'm sorry, but how much time do I have? It's 6:30 right now.
So you have a 7:30. So like,
Okay, fair enough, fair enough.
no issue.
So when we are talking about an R&D supply, it is an age-old issue which was carried from the service tax regime. In the service tax regime also, if we look at, there were two different scenarios. One was before the issuance of the place of supply rule, or formulation or enactment of the place of supply rule, and after the enactment of the place of supply rule. After the enactment of the place of supply rule, the two competing entries were the R&D supply was being, trying, the department SSC, they were trying to fit, depending upon which is beneficial to whom, or whether it will fall under rule 3, which was the general rule at that point of time, that is a recipient based location, or whether it would fall under rule 4 rule 4, I think rule 4A or rule 4B, where the performance on the goods was one of the indicator for the purpose of a place of supply, or the place of performance was regarded as a place of supply. So there, the scope of that particular provision was discussed. We have a Bombay Tribunal judgment in the case of the advanced therapeutics, where fairly this aspect of the R&D supply was concerned. And the issue was whether you call it as an import or an export. I think the other will be the mirror image. The question is, suppose I am carrying out an R&D activity in India, and the ultimate beneficiary of that particular R&D activity, or the ultimate recipient of that R&D activity is a recipient located abroad. Should I qualify or classify that particular activity as I can see that in the chat there are some questions. You can pour those questions. We will take it up at the end one by one, so that this flow of the presentation remains intact. So when it comes to R&D supply, the question comes as to, if I am doing an R&D in India and the recipient is abroad, should I treat it as a recipient-based taxation falling under Rule 3, General Rule, or should I consider it as a performance-based? When I'm talking about a performance-based, it requires me that there is a requirement that the goods should be supplied to me by the recipient. I should have acted upon those goods, and as a result of those goods, whatever is the final outcome that I have communicated to the recipient, that is the case. So the two things which were necessary is that the goods should be supplied by the recipient to me, and I should have performed on those goods. The question was how to interpret these two conditions. There, if one takes a view that the entire performance is happening in India, the sample or the goods on which the drugs, molecules, whatever you call it as a reference material, that reference material is given to me by the entity which is located abroad. On that reference material, if I am performing certain tests, and after those tests, suppose I am giving some readings, results, etc., in the form of a report and giving it back to my recipient abroad. The question is whether the goods are supplied to me by the outside person. Answer is yes. Whether I have performed the activity before arriving at the final deliverables. Answer is yes. As long as these two conditions are satisfied, the prevalent view was that in that case, I will go by the performance-based taxation, and therefore the performance is happening in India. Although the person or the entity which is carrying out an R&D service in India is getting the money in the convertible foreign exchange, and even if at that particular point in time the recipient is located abroad, all conditions of export of service are fulfilled except one, that the place of supply is not outside India but is in India. In that particular case, because of that failure of one condition, I was not getting an export benefit, and in that particular case the litigation arose that why we are denied the export benefit. And then the pharma companies started taking a view that we are not falling under 13.2 at all. It's a recipient based services performance. The scope of section rule 4 at that point of time is very limited. You have to look at it in a limited manner, and that question came up before the court or the tribunal in the case of the advanced therapeutics. Based on the same analogy, when you are looking at the import, again, the location of the supplier is outside India, the tests are happening outside India, the clinical trials, feasibility study, viability study, everything is happening outside India. Recipient is located in India. If you put it under Rule 3, recipient based, then the reverse charge would become applicable. If you put it under the performance based, there won't be any taxation because performance is outside India. It fails to come within the definition of import of service. And therefore, to that extent, again, in the hands of the import, there was an issue whether I should be paying the tax or not paying the tax. There, the department's view was different. They were saying, no, no, you have to pay the tax because you are recipient, you are in India. It's not a performance based. So in both the ways, there was a dispute going on. Then the question came as to how to resolve this dispute, how to tie up this dispute. Before coming to the GST regime, let me to tell you the same dispute is there even today in the GST regime. We have got section 13.2, which is pari materia with section 13, with rule 3, recipient based taxation. And we have got section 13.3a, a specific section, which is pari materia with rule 4, which was a specific rule. And we all know specific overrides the general, and therefore one needs to be very careful. One needs to have a very solid grounds to say that I am not falling into the specific category or the rule which is mentioned. And therefore, in that context, the advanced therapeutics, before coming to the GST, when the matter came up, the court took a view, the tribunal took a view, Honorable Justice Matthew's judgment, I believe, is that what he said is you have to look at the purpose. The purpose is that if the goods on which you are performing, if those goods are going to be vanished, if there is a change in the form of those goods, then I believe that rule 4a would not apply. But if you are doing something on the goods and those goods are supposed to be returned back the same form in its unaltered form to the recipient, only to that limited extent rule 4 would be applicable. So therefore, whatever action is happening on the goods, if you are saying that on that particular goods, you are providing a service, you are doing some finishing, polishing, some testing, whatever, the goods are supposed to be given back. It's not even that the giving back is an optional. The person who is giving you the goods wants you to perform the services on the goods with an intention to take back the value added goods again in his possession for further supply, if or for whatever business purpose. If that is the arrangement that you are looking at, only then rule 4 or section 13.3a would come into play. But if your intention is to give away the goods, not with an intention to take it back, not with an intention to take it back in its same form, or I would say there is no need giving back that particular goods is only, because those goods are costly, therefore you give us back. So the property in those goods belong to us. So if that is not consumed, if it is there, we will want it back. Uh, Ultimately, we are not interested in the processing that you have done on the good. We are interested in the outcome of the report, in all those things. There, I believe one can take a view that this particular 13.3a or the rule would not be applicable. So therefore, the tribunal took a view that where there is a goods which are coming back in its unaltered form, only then rule 4 would be applicable. Where the goods are getting consumed or getting its form is getting altered, they are not supposed to be, they are not intended to be taken back, rule 4 would not apply. And I believe that that is a right way of looking at the scope of rule 4 or section 13.3a. Therefore, in my view, where you are giving the goods for the purpose of manufacture, the goods are going to alter its form, and what you are going to get is a completely different article. One needs to really see. So, if the goods are being used as a raw material, whether you can use the performance-based supply or not, that one needs to see. Somewhere, I believe when the goods are changing its form, that is not falling within the purview of, so job working, when you are doing a job work, you are giving a raw material, goods are changing its form, what you are getting is a completely manufactured product different from the raw material supplied by you. In my view, there one will have to see whether this performance based things would come into play, because there the job work service probably one would be on the basis of the advanced therapeutics in a position to view that it is not applicable. Similarly, when goods are getting consumed during the process, there also I believe it is not necessary. Sometimes what happens, the raw material, it is not necessary that the raw material is required to be supplied by the supplier or the recipient. One can say that the raw material you buy from on my behalf. Say, for example, in the testing of some of the drugs, sometimes the efficacy study, the department, the recipient says that you purchase XYZ samples of the molecules from the market. I am not supplying you. You purchase it from the markets, you test the efficacy, you see the combinations, and give me the report. There also, the first question of whether the supplier has supplied goods or not, one needs to really consider whether that is getting fulfilled or not. If it is just a normal item, then one may say that it is not, it may not attract. And therefore, one needs to be really careful while applying this particular applicability of scope of Rule 13(3)(a). While I am saying that this job work, etc., may not fall under the provision of 13(3)(a), I must say that I myself am not very clear, have not formed my full view on this particular aspect, but at least on the principle, I agree that when something is required to be intended to be taken back, only then this particular rule of performance based supply would apply. If there is intention not to take it back, or if the end result is not on the processed goods, if you are not looking at the processed goods but something else, then at least to that extent I am sure that 13(3)(a) would not apply. Now coming to the GST regime, the same dispute was there before the GST Council. Pharma industry were representing that we are losing the benefit of the export because of this 13(3)(a), which view the department is taking up, and therefore the question came up before the council, and the council decided, they gave their view. They said we want to exempt this, but the limited, or rather treat it as a zero rated. But the limited question before us is not in respect of whether it is 13(2) or 13(3)(a). We are not going to get ourselves involved into those controversies. We have section 13(13). Okay. So what section 13(13) says? Section 13(13) gives them a power that whenever there is a double taxation per se, then in that particular case, they can decide what is the effective enjoyment of the service. And on the basis of that, they can define what is the place of supply. So they said, we want to give you the benefit, and therefore we will exercise our power under 13(13). And by applying our power under 13(13), if we have identified that in respect of A, B, C, D, E, F, G, these items, if it is a case of an export, if it is a case of these A to G items, and if these A to J items, there are certain other conditions like agreement should be there, etc. If these conditions are getting fulfilled, then you don't look at 13(2), you don't look at 13(3), you look at 13(13). You have to look at 13(13), you have to look at the notification 4/2019, and on the basis of that, you can say that place of supply is outside India, place of effective enjoyment is a recipient based, and therefore it is a case of an export. So the benefit was granted to the pharma industry as far as the R&D place is concerned in respect of some clinical trial, preclinical trial, bioequivalent studies, etc., etc. Some of the lists. You don't have to bother whether there is a performance on goods, not performance on goods when you are talking about an export. When it comes to import, the similar benefit is not available. The issue of whether it is under 13(3) or 13(5), again, 13(3)(a) or 13(2) again would come into play. One needs to take a view on a case-to-case basis, regarding reading all the agreement, whether the scope of the section 13(3) is getting attracted or not getting attracted, only on the basis of that they have to do. And therefore, I believe this place of supply issue is going to be a litigation when it comes to the import of service, whether it will fall under 13(2), 13(3), or those items which are not falling within that 13(13) notification. In respect of those cases, this is going to be a problem. This is going to be a litigation. So one needs to be careful about it. The next issue is about the transfer pricing debit notes and credit notes. So the question comes as to what would happen if I enter into a contract with my subsidiary abroad, with my sister concern associate entity abroad, or my sole distributor abroad. I told them that, look, you have to sell these goods, you have to export these goods, you have to incur. I am supplying you the goods at X value, you sell it at Y value. Now, so far so good, no problem. Same arrangement that we are generally making, the pharma is generally making in the with the Indian domestic players. The question comes, or the interesting aspect comes, that if as a result of that particular supply, the subsidiary company starts making the loss because the price at which it is sold to them is not enough to cover the expenses those are incurred by uh, that particular subsidiary, then in that particular case the question arises that the tax regulators over there would basically question the transfer pricing at which the goods are sold, or the service, or those goods are exported by the Indian entity to the associated entity abroad. And in that particular case, there might be a requirement that in order to reduce the loss, you issue a credit note. That means the associated entity abroad should issue a credit note to the entity in India, so that the income is getting generated and the loss is getting reduced. The question comes, how to give a treatment to that particular credit. Now, how it could be other way around also. It could be debit note also. Timing could also change. Timing could be quarterly also. So then now the question comes as to what actually happens. When we say that it is a debit note or a credit note, it has to be, when it comes to GST, it has to be qua the original supply. When it is not qua the original supply, at that particular point in time, the debit notes, credit notes given may not be, it's merely a transaction in money. If it is linked to an original supply, then one needs to really see that when I have exported the goods at 100, but I am getting a credit note of 40, but I have claimed the refund on rupees 100, whether receipt of that 40 credit note would make that I am supposed to give back the refund of 40 to the government, and I have to replenish my credit. Whenever I am giving that particular refund, he has to give me that particular credit back in my electronic credit ledger, whether that is the condition that I have to fulfill. Second, when I'm giving my refund back, when I'm getting a credit note, whether interest would arise, it will not arise. See, the question is, the most of the pharma companies, when they are exporting these goods, when they are entering into a rate contract with the subsidiaries, generally the concept of the transfer pricing debit note, credit note is also mentioned in that particular agreement, that it is linked to the original price at which they are supplying the goods to the associated entities abroad. If that happens, then obviously there is an original supply against which whatever is the quantum which is determined by virtue of a transfer pricing regulation is coming, and therefore they are adjusting that particular aspect. If that is the case, then I believe this entire mechanism of Rule 89 1B, where they have said that to the extent of credit note, you have to give back, to the extent of debit note, you have to pay more, and net effect of both the items you have to consider for the purpose of final refund. I believe this entire exercise needs to be taken up. The other way, if I do not link it to the supply of the goods that I am making, or that I am exporting, then what would happen? If I'm not linking it to the supply of goods, because ideally one would take an argument that the credit note is not qua a particular invoice or a particular goods that I am giving. It is absolutely not linked to a particular goods, because that is derived on the basis of my overall profitability abroad. It is not dependent upon my sale price. It is not saying if I have sold goods at X, I have to give. Sometimes it may happen that I have sold goods at different prices at different quarters, depending upon the situation. So it is not necessary, and my credit notes are coming to me maybe not every quarter. If those cases, therefore, it is not correct to say that transfer pricing credit notes which I am giving has anything to do with my supply. It is a regulatory adjustments which we are duty bound to do because of the transfer pricing regulations abroad, and therefore to that extent, I am supposed to raise the goods, supposed to raise the credit, accept the credit notes and pay back that particular amount, or take less amount. If they have already paid me, I have to pay back that particular amount. Even my 15 CA, 15 CB certificates, how I am preparing when I'm remitting the goods, remitting the money against the credit notes abroad. All those things needs to be looked at while looking at this particular aspect. The argument why the people are linking it to the supply or the export of goods is probably because if you don't link it to the export of goods, then one may take a view that the foreign entity abroad is not dealing with you on a principal to principal basis, but it is dealing with you as an agent. And if you treat that particular company as an agent, then the benchmark for the purpose of transfer pricing will change. If the benchmark for the purpose of transfer pricing will change, then again the transfer pricing notes, credit note, debit notes since will come. That generally, so companies will have to choose whether they want to go ahead with the transfer pricing credit notes, debit notes in a way that the less adjustments are happening because the benchmark of the agent and the benchmark of the principal to principal uh, dealer are completely different in the transfer pricing. If that is the case, then things will change. And therefore, to that extent, it is the company's call how to take it, how to treat it. If you treat it as a pure simpliciter transfer pricing, debit notes, credit notes, and refunds, independent of your export of goods or export or the supply of goods, then in my view, it is not necessary for you to make any adjustments in the refund. Those transfer, it has nothing to do with the supply. Those are purely and purely transactions in money, not, and certainly not the consideration or the adjustments or forming part of the price for any supply that you are making. And therefore, to that extent, one can simply plainly ignore it. But if your agreement suggests that they are resulting into the adjustment of the price at which you are supplying the goods originally, then there is an original supply, and then all these provisions relating to the changes in the refunds amount by taking a net impact of debit note and credit note that you needs to take. The way the circular is given, the way the procedures have been incorporated in law are very tedious. Showing it, linking it, it's very difficult. It is going to be a difficult thing. I have no personal experience of filing any refund claim as far as, or the filing any adjustment as far as this particular. So I'm not been able to tell you what practical things are there. But I just wanted to touch upon on these particular aspects, that how, in what circumstances those adjustments would be necessary, in which circumstances those adjustments won't be necessary. Sometimes the question comes, can I take a view that this entire debit note which is sent to me is on account of the fact that there are certain expenditure incurred in the foreign territory, and therefore if they are incurred in the foreign territory for which the debit note is raised on me, I am not supposed to pay any tax on it because that is an expenditure. The question of reverse charge. We all know that when the services are taken abroad, beneficiaries in India, in that particular case, the RCM becomes applicable. So, one view of defending, a wishful thinker defending, is that all these expenditure are done outside India. I have an associated enterprise outside India. It is belonging to business outside India. Then why I am supposed to pay reverse charge? It is only for accounts consolidation purpose that all these are considered into my consolidated balance sheet. Ideally speaking, it is not my expenditure also. It is somebody else's expenditure. They are just recovering it from me as a result of what you can say, it is just a business practice. So then why I should pay? Alternatively, assuming that it is my expenditure, still it is an expenditure pertaining to my segment outside India, which is talking about my income which is generated outside India, then why I should? Here the question comes, because if you take a view that entire business which is I am conducting outside India is not actually speaking my Indian business, but it's an export business, and therefore I will ignore expenditure for that, then you will also have to ignore the export, and you also have no reason to take the benefit of the export. And therefore in that particular case, in my view, it would be very difficult that if you take an export benefit, then the expenditure incurred, if any debit notes are raised on you by the foreign entity, if you decide not to pay that, tax under the reverse charge, even if otherwise it is falling under the reverse charge mechanism, the ground that these expenditure are pertaining to my foreign business, and therefore I'm no longer responsible for, there are these judgments of 3i Infotech and Milind Kulkarni and all those things. I think those line of argument would not apply. In service, it's a different proposition altogether. In service, there is a bar that when you are exporting to your own entity or the agent abroad, then that is not considered as an export of service. There you can take that particular stand that because it is not considered as export in my hands, that entire income that I am getting from my entity abroad is my income from the foreign entity. I am not taking any export benefit, and therefore in the import side also, whatever expenditure I am incurring for which I am reimbursing the money or repatriating the money abroad would not partake the character of the consideration. It would not come into my books as an Indian territory, and there is no GNK drive shafts and all those judgments may be applicable at that point of time, but not in the case of an export of goods, and especially where you have claimed the benefit of an export when those goods are moving from India to abroad, even if as an agent. So that is one thing that one needs to see. Whether the refund is required to be repaid to the extent of financial credit note, I just give you an answer. In my view, if earlier, before introduction of this rule, it was possible to argue that subsequent reduction in the price does not require me to give away or give my refunds back. But I think with the uh, new amendments coming up, this argument is going to be a little bit difficult. I would not suggest anybody to unnecessarily get into this litigation. Follow the law, and I believe if at all one gets into the litigation, then one needs to see whether the amendments made are adequate or not adequate. If one says that the amendments are not adequate to create a charge or charge for the purpose of getting back the refund, then because in the normal case, what would have happened is that, see, here the question is that you have encashed your credit into cash. When you are giving back the refund, you are giving it cash back and you are getting the credit again. That is the question. So therefore, technically speaking, there is no loss to the revenue or anything. All those sorts of arguments would come up in that particular case. This, I believe, is the last part of my presentation when it comes to the pharma aspects. We are at 7 o'clock. So maybe 10-15 minutes, I will try to talk about the general clinical establishments and all those aspects. Maybe 5 minutes I may spend upon that before we get into the question answers. So regulatory payments, applicability of the RCM. There are a lot of tests which are happening outside India. There are a lot of expenditure which is happening outside India. You may have a branch outside India. You may have a representation office outside India. You may not have anything. Just you may be having a distributor outside India through which you are making these payments or incurring these payments and reimbursing him. The question comes in such a case, do I have to pay the liability under the RCM? Now here, as I've told you, the test is whether the expenditure incurred outside India are liable to tax in India because the place of supply falls in India. If the place of supply falls in India, then technically speaking, the other entity is not having any right to, other country does not have a right to tax on that, levy tax on that, because otherwise it will amount to double taxation. It is on that ground we have the judgments in the past. I think it was the Abbott judgment, if I'm not wrong, where the court have taken a view, tribunal have taken a view that if the expenditure incurred outside India has already resulted into a VAT payment in those states, then one can say that they are consumed outside India, and therefore there is no question of any applicability of the tax because those are all expenditure relating to your businesses outside India. That was the judgments taken by, I think, Abbott, or some judgment was there which was taken in the past. One needs to really see whether the same analogy can be applied in the case of the GST when it talks about the place of supply and not necessarily the consumption base. which judgments were taken up at the time of export of service rules, import of service rules. There, it was more on the consumption. Here now we have got not just consumption, but the place of performance or the place of other parameters also for the purpose of deciding what is the place of supply. And therefore, once those goods, those parameters are there in place, I believe every expenditure that is being incurred on your behalf by your agent abroad, either subsidiary or otherwise, one needs to see the tax implication in your hands. Unless you say that that entire business is outside India and I am not taking any benefit, I am not taking it as a part of the Indian business at all. In those cases, yes, probably one may be able to take a view, but otherwise, each and every expenditure incurred outside India, you need to test whether it is liable to pay tax in India or not. So if as per the place of supply provision, the place of supply is outside India, you need not worry. You can say that it is outside India, therefore I'm not paying. But if as per the place of supply rules, it is liable to pay tax in India, you will have to pay, especially professional charges, etc. The local conveyance, local traveling, etc. All those expenditure, one can still be in a position to take it outside the purview of the GST on the ground that all such cases, the place of supply is really speaking where the activity or the service is actually happening. So therefore, my agents abroad have actually used it, and therefore the place of consumption is where the actual my employees are located who have consumed those, and therefore place of supply is outside India. So there most of the items you would be able to take out, but the registration charges, your ANDA filing fees, your professional fees, your legal fees, all these aspects, in my view, one needs to be very careful about. R&D expenses I have already spoken about, so I will not speak again. But all these aspects you have to be very careful about. And in my view, that the liability to pay tax would arise. One question about the ANDA fee or the regulatory fee is whether the exemption which is provided in the law for the regulatory fees is eligible, uh, whether the only Indian government would be considered or the foreign government would can also part fit into that. There, I believe the age-old dispute that is going on is whether they are providing a service or they are providing a function. Even if a foreign government is providing a function, is carrying out a function, statutory function, the fees paid may not partake the character of the consideration for a service. So those rules, whether it's a consideration for service, whether it is a service or whether it's a statutory function, that aspect, whether it would be a consideration or whether it is not a consideration, it is a part of it's like a statutory levy, not a contractual but a statutory levy. That one needs to see what would be the argument in those cases. And obviously the other part, whether foreign governments are involved into it or only the Indian government is involved into exemption, there I believe we have got a fair case to argue that this exemption which is given not necessarily would apply only to the Indian government, but would also apply to the foreign government, because although the definition of government is given in the law, I would not say that the context here requires for us to follow the definition of the government under the definition section, because the law is provided in such a manner that the taxability is arising on both Indian as well as the foreign entity. And if the taxability is arising into both the subjects, Indian subjects as well as foreign subjects, when it comes to the applicability of the pace of supply or any other applicability, then exemption also, unless it is specifically mentioned that it will only apply to the Indian government, only then it's a different matter. But otherwise, I think the liberal rule of the construction, the two phase, uh, two state interpretation you have to see. At the initially it needs to be constituted strictly, but once you enter into the language of the exemption, then it needs to be constituted liberally. So uh, whether the government used the word government used in the exemption, whether the context requires you to borrow the definition of the government from the act or not, that is the question one needs to see. If you succeed on those aspects, then I believe the exemption entry will be applicable. Otherwise also you have got the other defense. Most of the people to whom I know, they are paying the tax on these regulatory fees and taking the credit. That is the way that they are looking at. Uh, Payment of damages, in my view, we have got the judgments very category taking a view that the damages per se are not the consideration for services. They are to be considered as the damages, uh, liquidated damages or otherwise. So there I do not see that any implications of the taxation would arise. Another question is the payment of the out of court settlement. See, it is the question of what are the terms of the out of court settlement. If as a result of the out of court settlement you are continuing to pay the damages, may not be the amount of damages you may have been required to pay if the final verdict was out as a result of class action suit or anything, but some damages that you are going to pay by way of a compensation which are pre-decided, agreed, mediated between the party through the mediating agreement. In those cases, because in the foreign countries, these out of court settlements are also required to be presented before the regulatory authorities, and once they are presented before the regulatory authorities, they are presented before the appropriate appellate forum, and then they are considered, they are sealed, and then they are delivered. That is how the contracts or the out of court settlements happens. So what is the exact genesis of the out of court settlement, that one needs to see. If it is purely in the nature of payment of the compensation, then in my view it would not attract a tax. But if the out of court settlement gives rise to accepting the usage of a particular trademark or a usage of a particular patent that is breached, then in that case the free usage which is given in return from some royalty, etc., that may have to be seen in its actual form. That would not be considered as a compensation or anything. That would be considered on its face value, whether it is a transaction involving a grant of the license as a result of out of court settlement free of charge, or for some consideration to be paid depending upon the context, and on the basis of that the decision to pay the tax under the RCM or not to pay the tax under the RCM, or to treat it as a uh, what we can call it as an export of service. Anything can arise depending upon in whose favors, who is making the payment, who is receiving the payment. So these are the things which I believe are we have to see when it comes to the out of court settlement, whether it is a damage or the compensation would not partake the character of the service or the consideration. If it is giving away a right for a particular amount, lesser amount, more amount, whatever it is, there one needs to see whether it would partake the character of a consideration for services. In most of the cases, it would fall, and therefore there the question of payment of uh, reverse charge or the export would arise. That's it as far as the pharma sector goes. I will quickly maybe spend some 5-10 minutes on the other part of the healthcare sector. The clinical establishment. So the only two aspects I wanted to give my view, thoughts, food to ponder upon, thoughts to ponder upon, or a food for thought. The first one is that what is clinical establishment? Is it defined? Answer is no, it is not defined. But we have the regulatory framework in India for this clinical business, and one needs to see if I am allowed to carry out a clinical activity. Am I falling within the four corners of that clinical framework? If I found myself within the four corners of the regulatory framework, that means if I am undertaking a lab, if I am running a lab, and if that lab does not require licensing, does not require any regulatory framework, whatever I am carrying out, if that is otherwise falling into the care of human or care or diagnostic services or all those things, then there is no need for me to produce any license or anything. I can still be qualifying myself as a clinical establishment based on the services that I am providing. But if the regulatory requirement or the regulatory framework requires me to undertake certain licenses either under the Nursing Home Act or under the Clinical Establishment Act or under any other local state laws, etc., and I don't have that, and I am carrying out a particular activity, then in my view, it would be difficult to say that I am carrying out a clinical activity as a clinical establishment because I do not have the license. So wherever there is a licensing requirements, regulatory requirements, not just the activity that you are carrying out, but the character of your associate organization, qua those laws, in my view, are also going to be equally relevant. And therefore, the registrations, licensing, renewals under the respective enactments would tell whether you are qualifying yourself as a clinical establishment or not. If you are not qualifying yourself as a clinical establishment qua those laws, then if you are not registered, then in my view, you are outside the definition of the healthcare services in toto, or the exemption notification, which is only applicable to the clinical establishment or the paramedics, and therefore you don't have to go to the activity limb at all. The exemption would be denied to you. Now, if once you fall into the definition of the clinical establishment, as I just explained, then the second limb of the exemption, activity, it's a treatment, care, physical care, mental care, doesn't matter. So long as what you are carrying out, it fit within the pharmacology, or what you carry it as a medical science, as a care or a treatment, then in my view, entire thing will fall within the definition of the healthcare service. The only exception which are specifically provided in the law is the cosmetic surgery or the plastic surgery, which are made purely and purely for the beautification purpose, and not because of the to modify the or the for or to take care of your better. So even LASIK surgery. Now LASIK surgery can be done as a pure I just want to get rid of my lenses and I do the LASIK surgery. And if you do such LASIK surgery, probably the insurance claim would not be admitted. But if you have got a very high number and the doctors are prescribing that you have to carry out a LASIK surgery, otherwise you will go blind, then I believe in that particular case that LASIK surgery would also partake the character of the. So only specific exclusion is when it is not, it is done for the purpose of beautification, when it is done just for the purpose of ease or comfort, then I think one can say that it would not fall within that. Activity is not intended to be given an exemption. But in all other cases, so long as it falls within the four corners of a medical science as an activity for the purpose of addressing any sort of a disease or a discomfort, then in my view, the activity would fall within the definition of healthcare service. One more way to look at it is that in a professional syllabus, a syllabus where a particular person who is treating is getting a degree, a medical degree, whether that particular syllabus recognizes a state of a body or a state of a mind as an illness. If in that syllabus, if it is treated as a state of illness or the injury or anything, what you call it as, then in that case, that also will help. So a fact that there are specific degrees given for the purpose of giving a psychological treatment would make a treatment of the mind a treatment of a disease, because there are specific psychologists people available. There is a degree of the psychology which is specifically required to give you the medicine or to give you the treatment for the mental related aspects. That is also one of the indicator. If I have a degree for treating a particular situation or a particular treatment, in my view, it would be possible to treat it as a disease, a condition where a physical or the treatment is required. A paramedics who is qualifying to be a paramedics or a clinical establishment qualifying as a clinical establishment is addressing those issues, and therefore to that extent the exemption would be applicable. So that is the scope of the uh, clinical establishment or the healthcare service that I would be saying. Purely providing a service to a hospital may not get into the definition of a clinical establishment. A pure consultancy, you may be a doctor but you are not giving a medical consultancy, you are giving a consultancy just to avoid the legal suits, etc., etc., not for the care of the patient but for the care of the clinical establishment. In my view, that would not fall within the definition of a clinical establishment. So a pure advisory to the board not relating to the treatment or the condition of the patient, but in some other aspects, may not, in my view, would fall under the definition of the clinical establishment. So therefore, the contracts needs to be drafted very carefully when there are consultancy agreement or the as to see whether they are falling into the clinical establishment or the healthcare services or not. Supplying the medical devices not considered as a healthcare service, even if there are profit sharing arrangement, venture arrangement, one needs to really see there may be more than one services involved. Uh, Ultimate service to the patient, ultimate bill which is raised may enjoy the exemption, but the intermediary services which is taken or availed from the outsider to provide the services may not enjoy the exemption. They may have to take a tax, charge a tax, and that would constitute a dead expense because exempt services do not enjoy the benefit of the corresponding ITC. So that aspects one needs to see. One another aspect I would touch upon is how to keep the accounts. Pharmacy, ITC reversal. I have a pharmacy which is also dealing in the um, uh, actual retail license. So you require a retail license if you want to make an across the counter sale. If I have a retail license and I am making a retail sale, then I am also supplying to the hospital where the ultimate cost is being built up into the treatment to the patient. I am also supplying to the retail to the customers who are coming on the counter. I am giving them a retail invoices. There again, one needs to be very clear. The sale that you are making, it falls within the definition of a retail sale. Then the tax is applicable. ITC is eligible. If the sale that you are making is not forming part of the retail sale, then it would be considered as a part of the service element of that particular clinical establishment embedded in the final service that they are paying. And to that extent, obviously, the ITC needs to be reversed. The Rule 42, Rule 43 permits you to have an invoice-wise allocation of the eligibility and ineligibility, and therefore, if the separate books of accounts are maintained, or in my view, the proper logical bifurcation of the ITC credit is done on a consistent basis, then even that logical, consistent application of the ratio at the invoice level would be considered as an appropriate appropriation for the purpose of Rule 17.2 or for the purpose of Rule 42. That would be my view. And therefore, in that case, so long as your accounts, etc., are mentioned properly, calculations are perfectly done, and the ratios are consistently applied, the presentation is at invoice-wise bifurcation. In my view, you would still be able to claim certain part of the credit from the pharmacy as a specific credit as against the common credit that we generally call for the purpose of reversal of the credit. So that is as far as the other side of the healthcare dealing with the pharmacies, hospitals, etc. I think Bishan bhai, I have done whatever I wanted to speak on this particular aspect. And if there are any questions, I believe only one question is there. And in the chat, if I am not wrong, some chats are there. So I will first deal with these two, and thereafter, if there are any questions, we may take it up. So there is one question on by from Sandeep Gupta. Clarify whether the ITC to be reversed in the hands of the manufacturer in case of the promotional items given as a sale incentive. So yes, I think I have made it very clear. If it is the bought out item you are giving as a gift, so sales incentive is anyway you are required to reverse the credit. You can give the sales incentive by way of giving the credit note. You can give the sale incentive by giving a tour to him. You can give a sales incentive by giving him refrigerator, a washing machine. If these are the items that you are giving, obviously you will have to reverse the credit, because anyway they are not, they are not something which are meant for the purpose of further supply. It is the case where the company is the end customer. Although it is for the purpose of business, the provisions of section 17.5H will come into play, and therefore you would be required to reverse the tax. But on the other hand, the financial credit note given would not partake the character of consideration in the hands of the dealer, and dealer would not be required to issue any invoice for that. So that dealer is saved on that particular aspect. There is another question from Anshul Agarwal. there is a scheme if the dealer purchases goods above 10 lakh, he is eligible from 1 gram gold. Can gold coin be billed in invoice along with the other goods and discounts before the tax would be reduced? See, as I've told you, the gold coin, you are not selling the gold coin. If you are supplying two different commodities, one needs to see whether it's contributing to the margin of the dealers. If it is not contributing to the margin of the dealer, then it would not be protecting the character of the um, so the one gold coin. Now, one gold coin, obviously, when the gold coin is given, he can sell that gold coin. The argument would be that he can sell that gold coin. It is his gift. He can do it whatever he wants. So it is constituting the margin. Fair enough. But the question is, when we are talking about the discount in kind, whether it is a pre-agreed discount. If it is a pre-agreed discount, saying that if you achieved 10 lakh rupees, I'll give you a one gold coin. If you bill that particular gold coin and then show it by way of a discount, I think it is fair to argue that this is a discount because you are taking a gold coin, you are taking a credit, you are giving it back. This is not the case of the composite supply because the items, quantity, rate, everything is separately mentioned. Ultimately, you are showing it in the discount column because it was pre-agreed, because there is a terms of contract specifically stating. I feel no challenge in treating it as a discount. The only question here is that, no, even that question would not come. The credit would be available so long as it is considered as a deduction in the value. So the credit would also be available. One needs to test, there are a lot of schemes going on. Some people say that we will outsource the entire activity of the gifting to a third party agent. They will provide us the marketing service. So they will buy everything, they will take the credit and they will give us the marketing invoice. Since it is a marketing invoice, it will not fall under 17(5) because it is not the goods in respect of which gifts, etc. All those questions are coming up. One needs to really see whether these kinds of schemes would be, fulfilling the substantive character of the eligibility criteria, or whether the courts will look at it as a scheme to deceive the override the purpose, or one needs to really see because those questions have not come up. Very aggressive views in my view, but ultimately, if it comes to defending, I would not say that the defense is not available. Defense is certainly available. So, Bishan bhai, these are the two questions I wanted to deal with. Now, if there are anything else, we can take it up. We are already 6 minutes away from our closure.
Yes. So if any members or participants wants to ask any question, then they can definitely post it in the chat box. But I guess you have very well deliberated and everything is understood by our participants. So there are no queries at all. And if they want to ask anything, I guess your number was there in each of the slide. So member can connect with Mandar bhai and discuss with him as well. So now I request Vice Chairman of the committee, CA Rajesh Agrawal ji, to say a few words and share his well-deserved vote of thanks to Mandar bhai. Also, there is a request from the participant that please do share your presentation. We will be hosting it on the WRC.
Certainly, I will share. Certainly, I will
Thank
share.
you. Thank you.
Yeah.
Thank you. Rajesh bhai, over to you, sir.
Yeah, Bishan bhai, thank you. Very wide coverage with respect to the content is and delivery is concerned. You have not only covered one aspect of pharma industry, but even exports, imports, input tax credit, valuation. I think input tax, everything you have covered. The major doubts members may have, you have already covered exemptions and taxability. Really, thank you, sir, on behalf of WRC and GST and Indirect Tax Committee. I really extend our heartfelt thanks to the today's faculty, CA Mandar, Telang, sir, and also all the participants for your active participation. we are organizing multiple programs under GST and Indirect Tax Committee. Please be connected with the WIRC website to know the programs organized by WIRC. PPT, yes, already Bishan Bhai has conveyed. PPT and the recording will be available on the WIRC website shortly. So I think the message is very clear. WIRC website, you can download PPT. Thanks to all the participant technical team for supporting our chairman WIRC for supporting and available throughout this session on pharma and healthcare industry. Friends, nowadays, earlier pharma industry was only restricted with the big companies, Cipla, and like that. But now I think many small manufacturers and distributors are there. That's why clientele-wise, every CA may have clients with respect to pharma industry is concerned, healthcare industry is concerned, and the intricacies which Mandar sir has discussed, everyone is facing. Be it section 13 be it 15, be it 16, taxability is concerned, damage, amount received against damages. Likewise, many receipts are there. We have to decide taxability of the amount, valuation with respect to discount, incentive schemes, gift promotional item, input tax credit with respect to promotional item is concerned. Sir has covered not only provisional aspect but also many case laws, high court decisions. Sir, thank you for your all efforts, valuable insights you have shared, and everything was from your bottom of heart. You have shared thoroughly without keeping anything reserved from your side. Thank you very much from WIRC.
Thank you very much, sir. Thank you for
Thank you, Mandar Bhai. Thank you, Vishen Bhai, Rajesh Bhai, all of you.
Thank you.
Thank you. So let's meet again on next Thursday with different topic and another expert from the WIRC.
Ketan Saiya sir, thank you.
Thank you, sir. Thank you so much.
Thank you.
Thank you.
Thank you.
Good
Bye.
evening.
Goodbye.
Bye-bye.